L&T Finance, which has witnessed a 71% jump in its June quarter profits. Implementation of Ind AS resulted in higher tax expense. What are the other key highlights of the quarter gone by? Let's ask the management. Joining us now is the Managing Director and Chief Executive Officer, Dinanath Dubhashi. Also, Shraddha Babla from our research team, Johnson, to take the conversation forward. Shraddha, over to you.
Very good morning, sir. How much of loans have you sold down in the first quarter in your wholesale book?
See, sell down is just a mere small part of the overall strategy that we have, and you know we have continued our sell down engine quite well. Total sell down, I think our investor presentation talks is about around 5,500 crores. The important part is not that. What it shows is we are going ahead on our strategy of maintaining steady growth of the portfolio. So we have shown about 27% growth. Our strategy of retailization of the portfolio, that is where the sell down is important, that we book wholesale assets and sell it down, and hence the assets mix moves to retail. Our strategy of maintaining our NIMs plus fees at a good level. So our NIMs plus fees have increased from about 5.7 to about 6.6%, and then maintaining cost control quite tightly. Our cost to income is now at around 23%. And last but not the least, continuously improving asset quality. So all these factors, and not only the sell down engine, is responsible for this increase in ROE now to about 18.45%, and the increase in PAT that you are seeing of 71%. So that's really the whole picture.
Okay, your gross NPA, that is your gross stage 3, has come in at 7.93% in this quarter. Where do you see this number by FY19 end?
So it is important to understand the difference between gross stage 3 and gross NPA. It is not the same thing, right? We have moved to Ind AS, and Ind AS gives us the opportunity not only to classify greater than 90 days as NPA, but also assets which are standard today, less than 90 days, but where we see stress, right? So it includes all this S4A, SDR, etc., plus also standard assets where we see stress. And our entire this incipient stress portfolio of our legacy assets, which we had always said is about 5,000 crores. These are not all NPAs, even just about 50% of NPAs. But all of that we have classified as stage 3. So the important part is, as we are moving to Ind AS, we have actually identified the whole stress in the legacy infra book as stage 3. So that's number one. Number two is on the provisions of this. On this 5,000 crores, we had said that to resolve this 5,000 crores, to take haircuts on this 5,000 crores, we may require about 3,000 crores of provision. Over the last 2 years, we had provided about 1,200 crores of it. Today, and we had also said that we may require about 1,800 crores more to provide this to the completely required level. What we have done is, as we have moved to Ind AS, taken that entire 1,800 crores of provision through opening reserves. What it means really in simple language is not only the entire stress in infra is recognized and put in stage 3, but also the provisions required on them has been taken. So very simply to answer your question, from here onwards, both the gross as well as net stage 3 should only reduce, because the entire stress on the portfolio. So retail, of course, all the stage 3 has been taken. Wholesale, all the NPAs have been taken as stage 3, but also non-NPAs have been included in stage 3 and provided for. So these ratios will only trend downwards quarter on quarter from here.
All right, so then what is the mood and demand trends like in rural India? And also if you could tell us which of your rural product segments have done well in this quarter?
So all our 3 rural segments, which is farm, two-wheelers and microloans, have done extremely well. Generally speaking, rural India is doing well. Generally speaking, monsoons are expected to be quite good. With the rise in MSPs, the cash in the hand of farmers is supposed to be quite good. Generally, all the indicators are positive. Okay, but what we do is not just depend on it. Macroeconomic indicators, market is very important, but we like to outperform the market every time, both on market share as well as asset quality. What we do there is study at micro level, at taluka level, various factors, put them through our analytics engine and take very detailed decisions on manning, concentration on collection efforts, which market to grow, which asset to grow, and that has led to continuous outperformance of the rural market and this improvement in rural NPAs. And if you would have seen my investor presentation, my net stage 3 on rural is down to 1.75%. So that's very, very commendable improvement on asset quality coupled with the growth that is happening in rural. So to answer your question very simply, good growth is happening on all the segments. One note of caution that I would put here is the base is last year Q1, where we are not completely recovered from the aftermath of demonetization. So this kind of growth you will not see. The growth will be more modest but quite strong going ahead.
Specifically with respect to your housing finance business, how have the NPAs in the LAP and builder financing book moved in this quarter?
So as you have seen, the asset quality is quite steady. I will talk about both LAP and builder financing separately. LAP, we believe that the risk profile in the market is not quite good. The SME sector is under some stress and the market, even LTVs, etc. are going up. So we are slowing down our LAP business, most definitely being very selective in doing LAP. As far as builder financing is concerned, our strategy of completely concentrating on only the large builders, A category builders is playing out well. We are concentrating largely on A category builders and giving them a whole suite of products that has played out very well. And there is, our portfolio is doing pretty well and absolutely clean. So that's where we believe that we use our group synergies well to create a differentiated offering and monitoring mechanism in the builder financing portfolio.
Right, rural and housing businesses, I believe now together constitute about 46% of your total portfolio as compared to 35% last year. So say over the next 2 years, how do you expect the share to move as you move towards retailization of your portfolio?
Okay, so it has improved from 35% to 46% in 1 year. So you can make your own guesses. It will all be a function of how growths in various businesses happen. But largely, I think both these businesses together, our target, and I don't know whether it will happen by 2020 or 2021. I don't want to give such short-term guidances. But our target is normally these three businesses should be 1/3, 1/3, 1/3. Why that is? We like all the three businesses. We believe that all the three businesses are very profitable. But in a good diversified company, they should be balanced well. And generally speaking, we will guide the portfolio towards about 1/3, 1/3, 1/3.
All right. And what is the current scenario like with respect to the wholesale financing segment? If you could give us some updates there. And also, do you expect ROEs to continue to remain in the single digit for the wholesale finance business?
My investor presentation is already uploaded. So you will see now that these ROEs which were in single digits, we were always saying that this ROE is single digit because we are taking this accelerated provision for our legacy portfolio. Now that, as I said, the legacy portfolio is already provided for, and hence the ROE for wholesale is already at 15.6%. So we believe that this is the business capable of producing between 15 to 17% ROE, and we expect those ROEs to be there.
And so lastly, if you could leave us with some guidance for the AUM growth that you're targeting for FY19.
So book size, consolidated book size, we are expecting between 20 to 25% growth, which we believe is sustainable over the next 2 to 3 years.
All right, Mr. Dubhashi, thank you very much for speaking with Bloomberg Quint. Neeraj, that's back to you. Asset quality expected to improve from here onwards, but growth could look slightly modest on account of the high base of last year, but the stock doing fairly well today.